And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to The Real Investment Show. I'm your host, Lance Roberts, of course, and today is another episode of our interview series on the Real Investment Show channel. And today our special guest is Ben Gran. He's a freelance writer who covers personal finance and financial services, a graduate of Rice University, my dad's alma mater, mind you. Of course, back then, in the 1950s, it was a very small college. Today, it's a very prestigious university up there with the Ivy Leagues. And if you can get through Rice, you've done an accomplishment. Ben is based in Des Moines, Iowa, and has more than 15 years of experience as a freelance writer. He's written bylines in major publications like Forbes, Advisor, The Motley Fool, Business Insider, and more. And of course, has covered a wide range of topics in personal finance. And that's really kind of the subject of our conversation today, is a little bit about personal finance and, some of the kind of the takes of investing money, if you're doing it yourself, and manage your own personal finances, kind of talking about not just investing for your own retirement, but also talk about investing with children and for your children. And it's interesting because Ben and I actually share a very similar philosophy about teaching our children investing. And everybody would assume that Lance, you're in the financial biz, you run a financial firm, surely you're teaching your kids everything they need to know about Ben Graham. And and that is actually not the case. And there's some reasons for that. But Ben, welcome to the show this morning. How are you, sir?
Hey, I'm doing great. Thanks for having me.
Absolutely. So yeah, let's talk a little bit about this kind of concept of when it comes to teenagers and investing and kind of your thoughts around that. Because again, we talk a lot in the financial media in general about how important it is to, get our kids started younger investing. They have the advantage of time at their disposal. Unfortunately, what I see currently in the markets, in particular now, and really particular since 2020, is that we really didn't teach our kids to invest well in the markets. What we taught them to do was to speculate and gamble in the markets. Invest in the most risky stocks, invest in the most risky assets, invest in things that don't have any fundamentals, but just buy them because they're going up. And of course, a lot of this we can translate over to, it's a result of social media and applications like Robinhood. Nothing wrong with Robinhood, of course, but just a very easy application to get on, open an account, and start just trading stocks. And it certainly changed the dynamic of, kind of when I was raising my children. My children are older now; they're all in their early 20s. But when I was raising my children, it was a very kind of a different environment back then than it is today. And so I just thought it would be interesting if we kind of talk about, your observations. You're a bit younger than I am, but your observations about teaching your kids about investing and really as your article states, why you're a financial writer, but you're not teaching your kids about investing.
Yeah, absolutely, Lance. That's a good intro to the topic. I think my general philosophy on investing for kids, for teenagers, is that I would rather teach my kids how to save than how to invest, if that makes sense. Like I would rather help them develop that habit, that discipline, that sense of, getting a sense of accomplishment from putting some money aside in savings and thinking about the future. I would rather get them started on some of those more basic steps rather than have them thinking ahead to the more advanced steps of like, how do I deploy this capital, and which assets do I need to allocate, and what type of brokerage accounts do I need to set up? And I guess I feel like my kids are age 17 and age 15, and they're just kind of at a point in life where a lot of that the investing type of knowledge is just not as immediately relevant to what their lives are like today. And I think I think there's a lot of risk involved with investing, and I think in general it's a good thing for people to invest. It's a good thing for more people to invest. It's a good thing that so much of the markets have become more democratized, as far as just it's easier than ever to be an investor, an individual investor. But I just wouldn't want my kids to turn out like one of the cautionary examples of somebody that makes some risky bets on a meme stock or whatever, and, ends up losing a bunch of money that they might rather have had, growing slowly in the bank for a few more years, So I think there's a few things at work there. And in general, it's like, I'm just very sensitive to the risks of investing for teenagers, for kids, for younger people, in a way that I think in the media conversation doesn't always get discussed.
No, I think that's absolutely spot on because, again, just to look back and just the last few years in particular, Ben, I was writing a lot about the meme stock craze back in 2021. And, I was issuing warnings and I said, hey, I have seen this before. So Ben, just so you know, I've been investing money for over almost 40 years now. So I went through the dot-com crash. I went through the financial crisis. I've kind of been there, done that. And I've seen the devastation that occurs through these downturns in markets. But I was writing a lot about this, about the meme stock craze back in 2021, saying, hey, this is the type of environment where people lose a lot of money, and particularly younger people who are just starting that savings habit, right? You're just getting them going, they're just getting invested, and they're making money, and it's all very exciting, and then you basically lose everything. And there was a ton of articles that were written in 2022 about these same guys that were being championed in the meme stock market have now lost everything and gone back to work as bartenders in Vegas. And this was after they were on social media, with their Lamborghinis and their $1 million homes. Now they're back, waiting tables and bartending to try to make ends meet. And that's something that is very, very difficult to recover from. And, it's always interesting, Ben, that, we talk a lot about on our show is that we still have individuals today. And as recently as just a couple of months ago, we had a prospective client show up at our firm and said, you know what? I've been out of the market since 2008. I lost so much money in 2008. I just could not bring myself back to investing in the markets, but I just feel like I have to now. Here it is 15 years later, and they are just now starting to try to get back into the markets because of that psychological and financial damage that occurs during big market downturns. And, and unfortunately, we've taught investors over the last 15 years in particular, is like the Federal Reserve is going to bail out everything. Don't worry about downturns. You're going to get bailed out. But that's not always the case. And the damage to mistakes in investing can be very costly, not just to the near-term, emotional psychology, but also to your long-term financial outcomes.
Yeah, that's a really good point too. It's kind of like the biggest financial damage, if you're overly concentrated in any one stock, or if you get into making some kinds of exotic trades, like trading options, if you don't really know what you're doing. And yeah, like there's a lot of ways that people can kind of wipe themselves out. And it's not even just that loss, that's that one-time loss of capital that's the problem. It's like the way it changes people's risk tolerance for the next 20 years. And then they run the risk of missing out on some really nice gains for the next 15 years, like that happened with that person you were mentioning. Right. So yeah, I think it's important to be wary, just kind of have a healthy respect for those risks. I'm like you. I graduated from Rice in 2001, right in the midst of what later turned out to be the dot-com crash. And I remember when I was a college student, there were all these funny little companies. Like there was this company, I think it was called Cosmo.com. Right. And they would deliver like a bag of chips to your dorm room for like $2 or something, And like all these college kids in my dorm at Rice University were like, can you believe this? I just bought a cookie for 75 cents on the internet or whatever. Like, of course, like we should have known like this was a bad sign. It's like, wait a minute, this company's not making any money. Like they're losing $10 on every cookie they deliver. And 2001, some of the bills were coming due for some of those very unprofitable .com companies. And then I also had a kind of a friend of a friend who got a job at Enron back in 2001. Mm-hmm. And we were all really happy for her at the time. It's like, oh wow, good for her. And then a few months later, that whole situation went bust. And I remember my early years out in the world working, and it's like I was kind of making my first retirement savings contributions during like 2003, 2004, and if I remember right, like the stock market was still kind of in the that kind of long bear market after the dot-com bust, and it seemed like for a while it seemed like every time I checked my retirement balance, it was like lower than it was before. It's like
I remember
the more money
that.
I put in, it's like every single time I bought stocks, they immediately lost value the next day. And yeah, so I like back in my early years, I was like, well, okay, fine, I guess this is something I have to do. I have to save for retirement. I don't see it paying off anytime soon, but like those early investments today are worth a lot more than they were, in 2004. And so there's a lot of kind of those funny paradoxes of being an investor for the long term. And it's like some of the most important money you're ever going to make is when you're 25 years old and you feel like you can barely afford to go out for dinner with your friends or something. But it's like if you just keep socking away that money every month out of your paycheck and invest in a diversified portfolio and buy and hold and hang on and just let the magic of compounding do its work. Ultimately, that's what I want my kids to do, but it's just a little early for them to really have a good sense of what that even means. Like and again, I should also say, like, I'm not trying to like make investing sound like it's this, forbidden fruit that I don't want my kids to know about. It's like my kids know in general terms, I think, like what a 401k is, and I think they know what an index fund is, and they know what meme stocks are. Like they're familiar with just different topics of conversation on the internet that their friends are, talk about. But it's just like I don't know. I think for what the way I want them to relate to investing. Who knows? Maybe we're throwing away a fortune here. Like, maybe
No, I don't disagree with your view. I mean, so I'll tell you a couple of things I did with my kids, and then maybe you can share a couple of things that you've done with your kids too, because I think our viewers would appreciate that, particularly if they're trying to raise their own kids in this type of environment. But I never, like I am like you, I never taught my kids about investing. In fact, if you ask my kids, early on in life, what I did for a living, they had no idea what I did. They just knew Dad was on the radio. That's all they knew. And, I started out when my kids turned 16, I made them get a job. And I was very unpopular with my kids because none of the other parents where I live made their kids work at 16. But I made my kids go get a job. And I didn't care what it was. They were waiting tables and bagging groceries and doing all kinds of stuff. But, I just wanted them to understand the value of work. And when they got the reward of getting a paycheck at the end of the week. And I wanted them to connect those two things of working and getting rewarded by getting paid for that labor at a period of time. And so that was very important. And then I also made them, when they turned 16, they all wanted cars, of course, because they're 16, they had to drive back and forth to work. So that was fine. I helped them I gave them half the down payment for their car. They had to save up the other half of the down payment. And then they were responsible for the insurance and the car note. So they had to earn enough money if they wanted to drive to pay the insurance and the car note. The reason for that was to make them understand that there's responsibility in life. So great, you're going to go out and work and earn money, but you've got to work and earn enough money to pay your bills. And so this taught them kind of the basic foundation. Now, we haven't gotten to even talking about saving money yet. They were just trying to make ends meet at this point. But then once they kind of got the foundation down, then I started building a matching program. I said, look, if you'll put some money in a savings account, I will match you. So put $5 in from your paycheck, $10 in, I will match you to just give you incentive to do this. And we didn't actually even start talking about investing until they were well into college at that point. So, they had some money saved up, but it was just pretty much sitting in money markets. But I'm like you. I just wanted them to build the habit and the structure of that discipline of saving. You work hard for money, you get paid, you've got to save some money. And that was the big thing I wanted them to learn more than anything else.
I think that's a great approach. And that touches upon a few topics that have been interesting to me as I've watched my own kids grow up compared to what my life was like when I was their same age. And apparently, I saw some data about this a few years ago, but it's become just less common for a lot of teenagers to have a job nowadays than it was, say, 20, 30 years ago. And I think there's mostly pretty positive reasons for that. Like, it sounds like a lot of kids are just like, working, harder in, school, or they're doing like travel sports programs, or they're doing, they're doing other things other than, paid employment. But I think there's something so special about getting that first paycheck and just seeing some numbers in the bank for the first time that like, oh, there's this like moment of recognition, right? And it's like, I made that, I earned that. Like I stood on my feet all day in a restaurant or whatever. Like, because I got my first part-time job back when I was 14 years old, and I worked all through high school for the most part. There was a few times I took some time off to do a school play or do some other activities where I just didn't have time to work after school. But in one of my favorite jobs I ever had was working the front desk at a hotel, and I loved talking with the customers and just dealing with problems as they came up and working late nights. And it's like, you learn a ton from some of those part-time job experiences while you're still in school. I also think it just makes the money more real. It's like you can give your kids an allowance, and we do. Like we give our kids, I think we're giving them like $100 a month each, and because they just need some walking around money to go out to eat with their friends and spend on a few things they need to buy or whatever. And but it's kind of like the money's just not really real until you connect it to, okay, I stood on my feet for 8 hours at the front desk of the hotel last Friday night, and here's my, $48 after taxes, that I got. That's how little I used to make. I mean, that's
and I think that
wages used to be a little lower, but
exactly. And just real quick, Brent, be sure and clip that whole segment about the allowance. I don't want my kids hearing that. So,
yeah, that's right.
Yeah, thanks, Ben. Appreciate that.
The curve, yeah. I think.
That was
program is really good too.
Yeah. No, I think, and that was the other thing I meant to say about my kids getting a paycheck. I wanted them to learn about taxes. And when they get those deductions, I remember when my son got his first paycheck, he came home and he's yelling at me. He says, "Dad, they're ripping me off. I know how many hours I worked, and I know how much I got paid for every hour, and I only got like 2/3 of the money they owe me. I need you to call them and get the rest of my money." I said, "No, son, that other third was taxes." And he's like, "What is this? This is criminal." So, but it's a very important.
Some of the most painful taxes you'll ever pay.
Exactly.
It's like, oh.
I know, right? But it's such a good lesson. And it's interesting now, Ben, is that I was actually just talking to a parent over the weekend, and they know my kids very well, and my kids are very responsible. They're doing great in school, and they work while they're in school. They have to pay their own. I don't pay for college. They have to pay for their own school, so they've got student loans. They've got to pay for the differentials because I want them to understand the value of education. I want them to have that skin in the game. Now, and again, we're going to clip this out too. And once they graduate, then I'll talk about maybe paying off student loans for them or helping them, but they don't know that. But I think this is all very important lessons. And so I was talking to another parent that knows my kids very well, and they're the parent that is very much like you're talking about. They never made their kids work. They paid for everything. They did travel ball. They did all this stuff, which was fine and great. And now though, the kids are coming out of college and they don't have a work ethic. They don't really understand what it means to go get a job and have to deal with, having to deal with other people, having to answer to an operational chain of responsibility within a company. And they were like, "I really wish I would have done what you did and made my kids at least have some type of job, because it would have taught them some basic skill sets of working in a corporate environment."
There is a totally different way of showing up for a job. It's just different than showing up for school every day. It's just different. It's like there's a lot of those nuances and intangibles, and it just feels different when it's like, okay, you've got to be here at 3:00 right after school, and if you don't show up, people are depending on you, and you're letting other people down, you're letting your team down, like or whatever. And it's like there's carrots as well as sticks, right? But it's kind of like it's just. I think, there's just certain ways of being in the world that you have to learn, and you can't get all of it from school or from organized, activities, extracurriculars. Like, I remember some of the things I learned from my part-time jobs in high school, and one of them, a big part of it was just like learning to work with people from like other age groups, because it's like when you're in school, you're mostly just surrounded with kids your own same age, your own same graduation year. And when I was out, working on my part-time jobs, I'd be working with like some, young adults in their 20s, and some people that were all the way up to people that were like getting close to retirement age. And it was just like, that was just part of like, oh, okay, I need to, you need to figure out how to build relationships with a lot of different folks. And it puts you in a different context, that puts a lot of, teenagers out of their comfort zone, I think, in a really healthy way. And this reminds me, need to get my 17-year-old a job. Our 17-year-old has been on kind of a unique career and educational path, because his career goal, he's already very focused on what he wants to be when he grows up, and he wants to be an airline pilot.
Wow.
And which is really cool, and we're very happy for him. We're excited. We're supportive of it. But he's actually been in a really special vocational program that is offered by his high school, where they have an aviation program. Wow. And so his last few summers, he's been spending a lot of time like volunteering out at the hangar, fixing old planes and learning about aircraft maintenance and stuff like that. And so he's been working hard. He just hasn't been, he hasn't made any money yet. But we've been talking with him about, we would like him to get some kind of part-time job, if not for seasonal, retail. Mm-hmm. This holiday season, like maybe look for something in the spring, because it's like I think he would benefit in the same way most kids would benefit from that sense of discipline and structure and operating in a different environment. It's just different from you show up and sit in your seat at school all day and listen and take the test, and it's very individualized, right? And It's like when you're working at a job, like almost any job, just by there's more teamwork, there's more people that you have to show up for and deliver for. So I think that's all really good.
Yeah, no, and this kind of goes to an argument that I've had, for quite some time, which is, there was a bunch of pushback, a few years back. You remember about the $15 hour minimum wage, and we need to pay a minimum, we need to pay a living wage, for these jobs. And, I was like, no, this is not what minimum wage jobs are. Minimum wage jobs are starter jobs. They're, for individuals to go get a taste of working. It's also kind of a trial basis for the employer to say, okay, Brent, I'm going to hire you to come do whatever job this is, and I'm going to pay you a minimum wage, whatever that is for the state. And if you do a good job, I'm going to move you up. It was, the minimum wage argument was never meant to be a living wage. Like, you're supposed to be doing this job for the rest of your life. That's not what that was ever meant to be. And, when you talk about minimum wage, you're only talking about 2 to 3 million Americans that are working minimum wage jobs. And this was the lesson I wanted to teach my kids, was twofold. One is that most of the jobs they had when they were in the teens were minimum wage jobs. And, they would show up to work, they would learn the discipline, they would learn to, operate in that environment. But very quickly, they would work hard. They would show up on time. They would, put in extra time if needed. It was yes, sir, no, sir, yes, ma'am, no, ma'am, very polite, and did their job well. And they were quickly promoted and were making more money in a fairly short period of time because they were doing the job that was expected of them. But the other thing that I wanted them to learn, most importantly, was that's not the jobs you want to do for the rest of your life. I want to, get a taste of, I had one son that worked construction. He was like miserable because it was hot. I live in Texas, so it's hot and humid, in the summers when you're doing construction. And he learned very quickly that was not what he wanted to do for a living. And so now he's a mechanical engineer. But those taught them lessons about kind of understanding the basics of operation, but then also understanding that if I want to succeed in life and if I want to have a better standard of living, I need an education that will afford me that better standard of living. And that was the thing, that was the lesson I really wanted them to learn the most by working these minimum wage jobs.
Yeah, I think those are good points. I mean, I do spend quite a lot of time talking with my kids about, my kids have heard me say on a number of occasions just how lucky I am to get to do what I do for a living. Like, I love what I do for a living. I love being a writer. I love working with people all over the world. I love learning new stuff and just having interesting, unique little opportunities like these that come along, to come be on your guys' podcast, And I've talked with my kids quite a lot about how I don't have a lot of like hands-on skills. Like, I'm not like a handyman around the house. Like, that's not my strength. Like, I struggle with a lot of things, but I'm good at the writing and the talking. And
you and I are a lot alike, Ben.
Yes, right. But I've often talked with my kids about how, like, I have a ton of respect for people who do a lot of these jobs that don't make as much money as I do. And I truly try not to take any of it for granted. And what I've always tried to convey to my kids is just like, and it's funny, it's like, I'm not super worried about my kids. Like, they're both kind of thriving. Like, you know, I mean, they both have some strengths at young ages that I didn't have at that age. I mean, they're both in their own ways just doing great, and they're doing all the right things. And I've told them that as well. And, like, you know, you kids have, you know, you've never given your mother and I a moment of worry, really, in any important way. I mean, they're doing the right things and they're doing great. But I've often tried to talk to them about just, like, you know, you need to, if you work hard and you bring an earnest effort and a good attitude, you know, things tend to work out. Like, things tend to get better. And I've found that to be true for myself, and I hope that can be true for lots of people.
No, I think, and we talk a lot about that. We just had a conversation on the show this morning talking about capitalism and, you know, how to participate in capitalism. And, you know, it's, you know, to build anything, you've got to be able to take risk and understand that you're taking risks to do it. But to be successful requires a lot of hard work. And I am sure you, just like me, is that, you know, I'm very much like you. I love what I do for a living. I've been very fortunate to have the opportunity to do what I do. I'm very blessed to have the ability to do what I can do here. And that's fantastic. But, you know, it's taken years to get to this point. And it's always interesting. They say that, you know, the overnight success only took 10 years. And, you know, that's the thing that, you know, I try to get my kids to learn as well, which is that anything you want to do, and I just had this conversation with my daughter. She's in her first year of Baylor right now, and she wants to be a doctor, which is great. And so she's going through her initial kind of classes for pre-med, you know, chem and bio and those type of things. And it's very tough. And she's like, Dad, I don't know if I can do this. I go, you can do this. I said, it's very different than high school, right? In high school, they just fed you the answers for the test because they needed you to pass the test so they could get their federal funding. In college, they want you to learn how to think. So you have got to start learning to not just read the material, but learn to be a critical thinker. And the most important thing is that anything worth doing is hard. If it's not hard, it's probably not worth doing. And, you know, and she's like, okay, I get it. I understand. And that's the thing I think that we need to spend more time, you know, I need to work more on my kids, teaching them this as well, is that there's so many things in life today that are so easy to obtain. And again, kind of like with the stock market right now, just why worry about it? Just throw money in the stock market. It goes up every day. Why worry about anything else? You know, there's so many things that are easy. It seems like, well, this is the easy path to take, but to be truly successful requires hard work and effort. And like with her, she just needs to understand that the harder she has to work for it, the more worthwhile it will be in the end.
Yeah, I think there's just these last few years since 2020 with, you know, with this long bull market we've been having since 2009, and then especially these last 5 years, obviously there's pretty decent sized drawdown in 2022. But yeah, for the most part, the number is, the line has just kept going, you know, up and to the right these last 5 years.
Exactly.
And, you know, and I think, like, sometimes, like, I don't know, maybe I'm getting crotchety and old or something. Like, this is the point I've gotten to in my journey as an investor and as someone who follows the markets. Like, I just start to get a little nervous when everything seems too good. You know, it's like you know, it's like everyone's excited. Everyone's just dumping more money into the stock market. Everybody's just getting rich. And you know, I think I worry about that mindset. And it's like, I don't see this in my own kids, but, like, I have seen this mindset just in media conversations and just different interviews with kids. Like, my general understanding of the culture that a lot of, like, younger kids are coming up in today, there seems to be this, like, you know, or it's like a few years ago, everybody wanted to be a YouTuber. Everybody wants to get rich being an Instagram influencer and or whatever. And it's like, or a TikTok, influencer or whatever. And it's like, okay, sure. Like some small percentage of people do make a lot of money by building an audience and running a content creation business on the internet, but also, in the same way, a small percentage of people make money playing basketball, or baseball, or like, there's only one Caitlin Clark, there's only one LeBron James, and like there's millions and millions of other kids every year, or like there's millions of kids every year that try to learn to play guitar, and very few of them grow up to make a living playing sold out concerts in football stadiums. And so I think like I think like some of the get rich quick mindset, it's not all a bad thing, or it's not reflecting like some uniquely bad moral worldview that younger people have today. But I think part of it is like younger kids are under a lot of financial stress. They've seen the cost of living go up quite a bit. Like the world got turned upside down back in 2020, and but I think I do worry that we've kind of rewarded this like get rich quick mindset a little too much, and investing has been a little too easy in a way. It's like when you have several years of back to back double digit 20% gains in the S&P 500, and to say nothing of the Nasdaq and different positions people might have in individual stocks, like a lot of people have seen their numbers go up a lot, and that's great. But I think the question becomes, is it really sustainable? Like is that you're not investing for tomorrow. Most people aren't, like, unless you're a hedge fund manager or something. It's like you're probably investing for like 40 years from now, or more. And I think that's the other thing I've tried to one thing I hope my kids understand about investing in a general sense already is like it's a long-term game, and that's I have talked with them a bit about that. It's a long-term game. You keep saving, you keep buying into the market, you just gut it out if the market's in a downturn or if the news is scary. Over time, if you just keep dollar cost averaging into the market, that's another term I've used that they probably don't really know, understand, or care.
Do you get the eye rolls?
Yeah, exactly. Just like, Dad's going on about market timing again. So yeah, those are a few. I think the get rich quick scheme. I don't view the stock market as a get rich quick scheme. Yeah. I view it as a long-term, risk managed, prudent way of allocating capital. And my hope is every dollar I put in today, I'm sending it on a long journey, and it's going to be there for me in the future when I'm trying to retire, when I don't want to work anymore, when I can't work anymore, whatever the case may be. So yeah, it's all about time horizons.
It is, and we talk a lot about that as well as, and again, kind of to your point, we have. I did a study here just recently, and I looked at market returns from 1900 to 2008. And it's about what you would expect, right? So the average rate of return was about 8%. So take economic growth and your dividends, and that gets you about your 8% growth, which is about what you would expect out of the market. But since 2009, the average rate of return has been close to 13%. So in other words, just because of all the Federal Reserve interventions, because of zero interest rates, because of this kind of change in mentality of the markets have generated a 50% higher rate of average return over the last 15 years than what we saw in the previous 108. So, it's pretty phenomenal. What's been happening in markets. And of course, whenever you have that occur, you're going to start to reshape the way that people think. And this is the interesting, I don't know about you, Ben, but when I read other people's work, I'll read a lot of these articles where people are writing stuff like, this market just goes up. It just, just buy the market, it always goes up, et cetera. And then I go look up their bio, and like they started writing in 2011. They graduated college in 2010, type thing. And it's like, okay, you've never been through a bear market, so you don't really have any perception about the damage that occurs when bear markets occur. And we're going to have another bear market. Now, it may not be this year, may not be next year, may not be 5 years from now, but eventually something will happen, and you're going to get a reversion to the mean. That's just a function of how markets work. And eventually that payment, right, for all this ease and liquidity accommodation that we've had, there will be a payment for that at some point. But people have never seen that or been through that. And you've been through the financial crisis. You understand it. You saw the .com crash. You saw what happened to people in that. That's going to happen again at some point. I don't know what causes it or when it occurs, but there will be a payment for this ease that we have now. And I think that's the risk that a lot of young people are running into now, is that they've never seen a downturn. The people that they're watching or following on YouTube or TikTok or whatever in terms of, financial investing ideas, they're teaching them a lot of very bad habits without the perspective of what happens when valuations actually do wind up mattering.
Yeah, you're speaking my language. When I think back on what were some of the commentators that I learned from when I was kind of getting started saving for retirement and just trying to understand more about how the stock market works. And in my early years of saving for retirement, I truly didn't know much. It was just like, oh, okay, this is this thing I do every month out of every paycheck. And this is just, the right thing to do with this money and whatever, I'm sure it's fine. And I'll invest in some stuff. But over time, as I learned a little bit more about just, personal finance and investing, I remember reading some interviews with John Bogle, back in the day, founder of Vanguard. And I remember just reading a lot of quotes from Warren Buffett. And I've always, I always kind of try to take time to read the Warren Buffett annual letter to the shareholders of Berkshire Hathaway. And he's just, in his now deceased, his late business partner, Charlie Munger, was always a really good interview, just really quotable. And, but, Warren Buffett, one of his, quotable, folksy Omaha down-home sayings that I've always remembered, he said, be greedy when others are fearful and be fearful when others are greedy. And the only, the thing that I worry about a little bit with the stock market right now, and I'm not changing my asset allocations or anything over it, although I've thought about it, but I feel like everybody's just kind of greedy right now. I'm seeing a lot of bullishness. I'm seeing a lot of assuming that all of these hundreds of billions of dollars are getting invested in AI. It's all going to pay off splendidly. And, I personally am a little bit more of a skeptic about AI. I'm not really seeing I don't know. I've read both sides of the argument on it. And I don't know. There was also a really good book that came out recently from Vanguard, from their chief economist named Joe Davis, and it was called Coming Into View, and it was a discussion of the mega trends that could shape the next 10 years of the stock market and the economy. And their base case in this, their highest probability, most likely outcome that they see happening, they think AI will be successful in boosting productivity, helping us get 3% annual GDP growth. If that happens, there's no reason to think that, this stock market run up can continue and we'll just keep growing for several years to come. If AI somehow disappoints, which I think they had at a 25 or 35%, probability, if AI disappoints and some of these big companies pull back on all these investments and it turns out that they can't develop really specific use case, productive, tools and applications and businesses with all these large language models. And if a lot of this investment turns out to kind of be wasted, then you're going to want to be in bonds,
right.
But no one knows for sure, which side of that fork in the road is going to come next. And so as far as what I worry about right now, with the stock market, that's kind of what I'm worried about. It's just kind of okay, does this tech boom still have more legs, or are we gonna run out of road? And because it's we've both seen it in our own careers. Sometimes the stock market goes in the tank, and it takes a few years for people to get back on their feet.
Well, and again, when I built my first investment firm, it was back in the very late 90s, and so watching the .com crisis unfold real time, does remind me a lot of this because, back then it was like, oh, the internet thing, there was one group of people says, oh, the internet's going to change everything and it's going to massively increase productivity and do all these other great things. And companies were obviously investing, hundreds of millions of dollars, back then in fiber optic cable and everything else, doing these build outs. And there were plans to have fiber optic cable connecting every part of the world, et cetera. And the internet did change things. It did massively increase productivity, and it did fulfill all of the expectations that everybody thought the internet would actually do. Unfortunately, though, the over-expectation by Wall Street of what these companies could actually deliver was way too far from reality. And the productivity did happen. We use the internet every day, right? I mean, it's made our lives massively better, but the profitability that was expected to come from it didn't mature. And of course, now, in all fairness, there were a lot of companies back then that had no business plan, no revenues, et cetera, versus today, NVIDIA has massive revenues, et cetera. But there's a lot of companies right now that are trading at massive multiples that have actually no revenue at all. But they're publicly traded. And it's all in the hope that, to your point, that AI will generate this massive future and all these type of things. And maybe it will. And I do. And personally, I expect that AI is going to be much like the internet. It's going to massively change our lives. It's going to make things easier to do things. We're going to have robots in our house doing all kinds of stuff. But there may be a very big gap between the expectations of future profitability that exists now and what actually comes to fruition. That could be a very big gap.
Yeah, that's really true. And I've kind of read a few different points of view on this lately, because someone I saw a chart that was kind of tracking like the historic share prices to earnings ratio of the .com boom, like 1998, 1998, 1999, 2000, versus like where we are right now with the S&P 500. And it was kind of like very closely, tracking. It was kind of like, just the idea of like the market is kind of getting similarly pricey compared to what it was back in the late 90s. However, that might be okay because the companies that we all are, buying into today are more profitable companies, and they're better companies. They're better stocks to own than what the S&P 500 was 25 years ago. And the other thing that about the recent AI investment is a lot of it has been coming from these incredibly profitable big tech companies like Google and Meta, that they've basically been paying for all of their AI build out with current cash flow, right? It's right. Like they haven't, and they're continuing to be really profitable even while doing this AI venture. So I think there's definitely some good arguments to be made that for both possibilities. I also think like kind of a third way on the AI argument is kind of like what like you mentioned with when all the broadband got built out in the late 1990s, and how there's this huge telecom boom and then bust, and then suddenly there was a bunch of spare capacity for broadband cable, and no one really knew what to do with it at first, right? Until like 2005 when something called YouTube, came around. Yeah. And okay, all of a sudden we have all the infrastructure in place for like the future of the streaming internet and video calls and lots of great stuff. So I think there's a case to be made that like even if some of the investments being made today don't pan out to be as profitable as they'd hoped, like it doesn't necessarily mean it's all wasted. And yeah, so sometimes it takes another 5 or 6 years. Someone's always tinkering in their garage, right? Like
exactly.
Someone's always trying to find some new way to solve problems, and digging into some overlooked or unglamorous or we thought it was all played out, corner of the economy, and sometimes that's where the future growth comes from.
No, and that's absolutely right. But the important part about what you're saying is, though, and this is the thing I think investors need to be paying attention to, is that the expectations are that this massive profitability will be immediately available, and so stocks are being priced on that assumption. So even if AI is as profitable as everybody thinks, but if there's a gap between that profitability arriving, you could see very easily companies like Nvidia get cut in half, and the stock would still be in a bullish trend, even if that happened in price. You could see those kind of declinations. People don't remember back in 2020, Nvidia lost about 80% of its value, and then it came roaring back. So it's easy for these companies to have very big drawdowns, and this is why we talk a lot about risk management. And if you're managing your portfolio, be careful of the risk you're taking, because even if all the expectations for AI turn out to be true, that still doesn't negate the ability for the market to have a fairly sufficient drawdown that could really impact your future values. And so it's something to at least be mindful of as you're investing.
Yeah, that's a really good thought too. And I think, like, for me, the other thing with with the meme stocks, or just picking stocks in general, or just I obviously, some people, there's a role for some active management in their portfolio, and I don't mean to say never ever try to pick stocks. I mean, that's not, I personally don't, but that's just how I invest, because I'm lazy that way, but
sure.
But like, my general philosophy on picking stocks or meme stocks or whatever is like, I don't know, isn't just the S&P 500 risky enough?
How much risk do you need?
Yeah, just because, like we can get, these big drawdowns, or like 2022, like wasn't like Meta down like 60% or something?
Oh,
Like,
yeah.
I think Amazon was down like 65 or something,
Yeah,
70%.
absolutely.
Yeah, so like, and these are like the biggest, most profitable, companies in the world. So I think, as far as like for talking to kids about investing, I've tried to convey that sense of like long-term, roll with the punches, try not to fixate too much on what happens day to day in the headlines, and try not to let the news headlines scare you or put you off your game or whatever, like, because, stocks go up, stocks go down, but most of the time stocks do go up, like in the long run. If you're putting money into the market, you just need to have that long-term mentality.
Absolutely.
And I think that's the biggest thing. It's an optimistic message too. It's kind of it's a philosophy of life as well. It's like, if you just keep working, you just keep doing what you do, you keep believing in the future, you keep doing the right things along the way, things tend to get better. And that's what I'm trying to teach my kids.
No, and look, I think that's brilliant. And you wrote an article too that says, I was a sole breadwinner in my family for 10 years, and I learned that money can sometimes buy happiness. And that's what I tell my kids a lot too, is to be happy is not just about having money. Having money helps being happy. If you're having financial stress all the time because you can't make ends meet, it's very difficult to be happy. And they say the top two reasons for divorce are infidelity is number one, and finances are number two. But if you're having a lot of trouble with finances, that probably is going to lead to infidelity at some point, right? Just because of the stress within the marriage. So, finances have a very, very important impact on happiness within your family, within your life, those type of things. And so, and this is why I try to teach my kids, it's very important to learn how to save and how to invest ultimately. But more importantly, like we started out our conversation, is learn how to save money. Don't spend everything you make, because there's going to be times that life happens and you want to be able to deal with it without it ruining your entire life. Because, I've seen that happen so much to so many different families. They live one or two paychecks away from basically bankruptcy. So if anything goes wrong, they have no cushion to absorb that. And it's very hard to find happiness when you're constantly stressed about finances.
That is really true. And I think like the living paycheck to paycheck problem is something that affects a lot of people, even with higher incomes. And I think there's a lot of families in this country that, okay, you've got a mortgage, you've got a couple of car payments, your kids are in travel soccer, like there's always something new you've got to pay for with school, and it's like, but before you know it, you're spending 98% of your monthly take home pay, and like you don't have much of a safety net. You don't have much of a cash savings safety net underneath you. And I've always been a saver. I hopefully not in a way that is impractical, or I really don't think my kids have lacked for anything important in life because, I was trying to save money that month instead.
Right.
It's like, no, we can't go out for ice cream. It's like,
You're a bad dad.
Like that.
Yes.
Yeah, exactly. I think I always bought them whatever little, Hot Wheels Matchbox car, whatever they wanted at the grocery store. Then when we were out running errands. But I think like for me, saving money feels most of the time like just as good or better, than spending it. Like I sometimes like if I have to make a purchase for myself, I have to get a new outfit, I'll have to like upgrade my wardrobe or something. Like I sometimes just feel weird like spending a bunch of money on myself. Like I feel better most of the time like making a contribution to my IRA or it's like watching those numbers go up feels really fulfilling for me in a way that I think a lot of people get those positive brain chemicals from spending. I get it from saving. And so I think like and as far as being a sole breadwinner, like we went through some years looking back on it now where it's like, gosh, maybe I should have worried more about money. Like it's like like in retrospect, I'm kind of amazed we made it through. But we were able to. I think like you're always investing, whether it's money or time or energy or your relationships or whatever. It's like everything we do that we're trying to build toward the future is an investment, whether you think of it that way or not. And for me and my wife, like back when our kids were small, like we just really felt strongly like that was how we wanted to raise those kids. And we're incredibly lucky that we were able to do it the way we did. And not every family is able to do that, and not every family wants to do that. Like some parents are like, oh man, I love these kids, but I need to send them to daycare so I can, have my brain back and like, be productive and have my career. And like, that's really valid. I mean, there's lots of ways of being an adult that, you kind of risk losing touch with if you're home with the kids, and you're not out in the world in the same way. And, but I think like, we just wanted to invest so heavily in those kids. And, I think every parent feels that way. It's like we all invest in our kids, like whether it's saving for college or whether it's trying to teach them good lessons about about money and life and work and relationships. And the other thing too, it's like paying for college, like helping your kids in the future. Like, yeah, like I think Lance, what you said is like that's a perfectly good approach. It's like having your kids invested in the success of the endeavor, right? Right. But at the same time, it's kind of just a 6 of one, half of the other in a way, because it's like some parents are like, we saved for this, we're going to just try to pay for as much of it as we can up front, and then some parents are like, we saved for this, take out these student loans under your name, and then we'll let those investments grow for a few more years, and maybe we can help you out on the other side. So it's kind of like, there's more than one way to do it, and but I think like one of the great honors of my life, I'm so grateful for it, is like I have gone from situations with my family where we racked up some credit card debt because we had a car that needed to be repaired, and like we were down to not very much of our like liquid assets left in the bank. I mean, but I'm so lucky that I've been able to go from that situation to like we've been able to go on amazing vacations together, like to Tokyo and London and Europe, and we've been able to travel, and the kids are getting to do what they want in life. And as my fortunes have improved from some like early days when I was kind of struggling a little bit and like trying to build up a business and try to build up a client base, and I've been able to kind of keep investing in my kids in different ways, and awesome. It feels really good. It feels really good to be able to provide for people and to be responsible and be the foundation for the family like that. It just it feels really good.
Absolutely, and congratulations. That's an awesome story. Ben, hey, we ran a little bit long, and I appreciate all your time today. It's been fantastic. And Ben Gran, again, he writes lots of articles. He writes for Business Insider. He writes for The Motley Fool, also for Forbes Advisor as well. So you can find him out there. All of his articles are a fantastic read. I certainly encourage you to read them. Ben, really appreciate your time today. Love to have you back sometime. So we'll keep a watch on your articles. And if there's a good article that we can sit and spend some time talking about, I'd love to do it with you.
Absolutely. Thanks so much, Lance. This was a ton of fun. I appreciate the opportunity, and have a great day.
Absolutely. Thanks, Ben. You've been listening to The Real Investment Show. Be sure and like and subscribe to the channel. It certainly helps us a lot and helps us get good guests like Ben Gran here on the show. So again, like and subscribe to the channel. Be sure and follow all of our work at realinvestmentadvice.com. Have a great day, and we'll see you back here in the next edition of The Real Investment Show.